Now we will solve one problem from chapter 14, and our first problem is E1417A, which is on page number 873, and you can see the problem from here too. And here in this problem you need to calculate some ratios. Again, in this chapter you mostly need to calculate ratios. If you already watched my PowerPoint slides on this chapter content, then you should get some idea how you can memorize all those ratios and what are the ratios you really need to know to practice all these problems. So I also uploaded one formula sheet. If you go to your Blackboard, then you will see this type of sheet, and I would suggest please print out the sheet, make a flashcard, or write down the formula several times and try to memorize all those formulas. So you will not be given any formula during the exam. You really need to know the formulas. So you will see that you have different boxes. So each box contains some formula, and the purpose of those boxing is that each group actually evaluates different type of performance. So here if you focus on the first two boxes, first box is showing the ability to pay current liabilities, and the second box is showing the abilities to say sell inventory and collect receivables. So when we need to solve this formula here, E1417A, we basically need to focus on this first and second boxes. So we'll try to write down the formula and we will plug in the numbers. So this chapter is straightforward. If you know the formula, then you just need to plug in the numbers. Again, please write down the formula several times, or make flashcards, or find your own way to know the formula. But I'll explain my tips, which I already did when I went over the PowerPoint slides on this chapter, how you can memorize the formula. So let's try to solve this problem E1417A. So here you will see that a part of your balance sheet and income statement is given, and 2 years information are given here for 2 years. One is the current year and another is the preceding year. Because I already discussed, if you need to calculate any ratio and the ratio contains one income statement item and one balance sheet item, for the balance sheet item you always need to take the average. So average means you need to take the past years and the current year's information, you need to add those two, and then you need to divide it by 2. This is how you can figure out the average of some balance sheet items. So let's try to do the problem, read the problem and solve it. And here it says that you need to compute the following ratios for the current years. These are the current ratios: assets test ratio, inventory turnover, and days sales in average receivables. So again, you really need to know the formula. Let's try to solve the problem together. E1417A. And I will write down the formula again, and I hope you will write it down few times. That will actually help you to memorize the formula. So number A says to calculate the current ratio. So this ratio is actually says your capability to pay your current obligation. So if you check the formula sheet, it is actually current assets over current liabilities. So this is the first formula you need to know to calculate the current ratio: current assets over current liabilities, and everything is given here. So you know current assets items are what? Current assets are cash, short-term investments, notes, net receivables or account receivables, and you also need to take your inventories, prepaid expenses. So basically these are your current assets, and the problem is very nice. They actually gave you the total current assets here, the total of all these. So you can pick the current assets from here, and total current liability is also given here. So to calculate the current ratio, the formula you need to know is that current ratio is equal to current assets over current liabilities. So once you know this formula, you can just go to your problem and you can plug in the numbers. So let's go to the problem. It's actually given here. So you don't need to write down all the numbers since they actually gave you, but for some problems it may not be given. In that case you need to calculate it. So here your total current assets is given 171,990. So that's your numerator or the top part, 171,990. And if you divide it by current liabilities, which is also given here, and remember we are doing for the current year, so I'm just taking the current year's information. Your total current liabilities is it's given here 117,000. Now please take your calculator and do the ratios. So if you do the calculations, 171,990 divided by 117,000, I can go to the next line so that it looks a little better. Then you can calculate it. So I did it with my calculator and I found 1.47. So that's your current ratio, and we will write it times. That means your total current assets are 1.4 times than your current liabilities. And remember, higher is the better, but too high is not good. But obviously current ratio more than 1 is good for your company. Now the next formula or the ratio is about the acid test ratio, and there is another name of this ratio, acid test ratio. You can also call it the quick ratio. So the next item is the acid test ratio. So again, this ratio is actually showing your capacity to pay your current obligations. But here, instead of taking all current assets, we will take like very liquid assets. Those are two current. That is like cash, short-term investments, and net receivables. These three items are very liquid, right? So these are also known as the quick assets. So the another name of this ratio is the acid test ratio. I can show you the formula sheet here. Acid test or quick ratio, it is the top part is cash plus short-term investments plus net receivables, and the bottom part is your current liabilities. So here in this case you probably need to write down all those items. Here cash, short-term investment, and receivables, we need to take all these three and then we need to divide it by your current liabilities. So first I'll write down the formula, and I'll also request you to write it down several times, so it will be really very useful. So my top part is cash plus short-term investments plus net receivables. Net receivables and account receivable both are same, and we will divide it by our total liabilities. So our total liabilities, we will divide it by our current liabilities. So now if you plug in these numbers, I'll minimize a little bit so you can see the whole thing together. So if you plug in the numbers, everything is given here. So let's plug in the numbers. Your cash is given here. Please read it from this problem. Cash is given 16,000 plus short-term investment is 14,730. Remember, we are doing only for this current year. Plus net receivable is given here 50,000. So that's your top part or the numerator. And now for the bottom part, it's your current liabilities. So we're gonna divide it by our current liabilities, which is given here. Total current liabilities, it's 117,000. So now we will use our calculator to calculate those numbers. So if I add all those numbers, now our top part 16,000 plus 14,730 plus 50,000, and then if you divide it by 170,000, what I found is 0.69. So this is my acid test or quick ratio. Now if I need to explain it, it's actually not good. So usually if acid test ratio is higher than 1, it is considered as good. That means you have all those very liquid assets and you can use all those assets and you can pay your current liabilities immediately. So if it's more than 1, then it is considered as good for the company. Now we will do our third ratio, which is given here. Third ratio is the inventory turnover ratio, and we will check our formula sheet. So inventory turnover ratio is you are kind of expressing your cost of goods sold in terms of your average inventory. So here you can also call it how many times the company actually has inventory turnover. So if you check the formula sheet here, the formula is the cost of goods sold over average inventory. Remember, in these ratio, one item is from your income statement, which is the cost of goods sold, and another item is from your balance sheet, which is the inventory. So if you have this type of formula, one is from the income statement, another is from the balance sheet, you need to take the average of your balance sheet item, and that's why average means past years, preceding years, and the current year's average, and that's why you'll be given 2 years balance sheet. So this ratio is actually this ratio indicates the sellability of your inventory, and of course higher is the better. Now let's go back to our problem and check the numbers. So I will write down the formula again. Inventory turnover ratio means cost of goods sold divided by average inventory. Average inventory. Again, for the balance sheet item, we're going to take the average, and you need to figure out how you can calculate the average. Average is means the preceding years plus current years and then divided by 2. So let's check the cost of goods sold. So the cost of goods sold is given here. For the current year, it's 323,400. 323,400. Now you need to divide it by the average inventory. So average inventory, I can put it within bracket so that you can separate it and the chance of doing mistakes will be lower. So now for the bottom part, I'm using another bracket to calculate the average inventory. How you can calculate the average inventory? Average inventory means the preceding year's inventory, which you can see 73,000, plus the current year's inventory, which is 74,000. Add these two and then divide it by 2. So that means 74,000 plus 73,000. Add these two and then divide by 2. So this is how you can get your average inventory. I'm using another bracket just to separate it. So this is our bottom part. Now let's do it. So I'll use another line to write down the average inventory. So our top part is already given, which is the cost of goods sold, 323,400, and it will be divided by the average inventory. How you can calculate the average inventory? Preceding years plus current years divided by 2. So let's do it first. 74,000 plus 73,000 divided by 2. I got it is 73,500. So now you got your average inventory, which is the bottom part, and if you use your calculator, 323,400 over 73,500, and I got it 4.4, and we'll call it times. That means it indicates the sellability of your inventory on an average. They will have 4 times or 4 times inventory turnover, and again higher is the better for the company. Now our last item is talking about day sales in average receivables, and it actually says how quickly you can collect your receivables. So if you make any credit sales, it creates an account receivables, and this ratio will tell you how many days it takes to collect those receivables or to collect those cash from your customers. So we will check the formula, and we'll try to interpret it so that you can remember it. So our next form ratio is days sales in average receivables. And let's check the formula first. So here again we are actually expressing our receivables in terms of the collection of receivables in terms of days. So how many days it actually takes to collect those average receivables. So the formula is here. For your top part, you need to take your average receivables, average account receivables, and then you need to divide it by 1 day sales. So the formula is, again, the top part is average net account receivables divided by the bottom part, which is 1 day sales. Now you may not know 1 day sales, but the total sales will be given and you can divide it by 365. This is how you can get your 1 day sales. So let's write down the formula, figure out the numbers, and then plug in the numbers here. Again, it's average account receivables divided by 1 day's sales. So let's write down the formula first. I'll suggest you will also write down the formula. So if you write the formula many times, it will be helpful for you to remember the formula. Accounts receivables, this is my top part, average account receivables divided by 1 day's sales. Again, 1 day sales may not be given, but if you know what is your total sales and if you divide it by 365, then you can calculate 1 day sales. So now let's try to plug in the numbers. Okay, so it's a little bit long formula, but we'll try to plug in the numbers here. So your top part is the average account receivables. So to know the average, what you need to do, you need to take these 2 years, current years plus preceding years, and then divide it by 2. So if you check the receivables, it's 50,000 plus 76,140. So I will take these two numbers, which is my current years plus the past years receivables. I think it's 140, and then I'm gonna divide it by 2. So this number will give you the top part or the numerator, which is our average net receivables. Then you have to divide it by 1 day sales. But we actually don't know what is my 1 day sales, but we know our total sales. And sometimes it may say credit sales, net sales, total sales is all same. All these are same. So net credit sales, and of course these are for the whole year, which is, you see from here, 434,350. So 434,350, but this is for the whole year. So we're gonna divide it by 365. And if you do so, you will get your 1 day sales, right? So here, this is the bottom part, 1 day sales, your total sales divided by 365, and the top part is your average receivables. So let's do the numbers first, then we'll calculate the ratio. So let's calculate this top part, which is your average receivables. Last year's receivables plus current year's receivables divided by 2. So if you do it, 50,000 plus 76,140 divided by 2, I got 63,070. Now if you do the bottom part, which is your 1 day sales, this is your total sales, and you need to divide it by 365. That means 434,350 divided by 365. What I got is 1,190. This is my average sales. Now if you divide this numerator by denominator, I found 53, and the result will be in terms of days. That means it takes on an average 53 days for the company to collect their account receivables. Remember, for this ratio, lower is actually the better. So if you you take too long to collect your accounts receivables, it's not good for you. So lower is the better. So basically you just need to calculate the ratio. You don't need to interpret or compare it with your competitors. But if you need to compare it, and if you see that your one is actually greater, the number of days it takes longer time compared to the industry average or your competitor, it may not be good for you. Okay, so that's it. And now we will practice one more